Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. LDP supermajority propels Nikkei to record. JGB yield surge. 2. China tells banks to pare US Treasury exposure. 3. Tech rebound, weak dollar and data cluster reprice global risk. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. LDP supermajority propels Nikkei to record. JGB yields surge. Primary asset classes impacted. Japanese equities, Nikkei 225, Topix banks, cyclicals. JGB 10Y, USD/JPY, global rates via yen carry trade. What happened? LDP secured a two-thirds supermajority with more than 316 of 465 seats, removing policy gridlock and cementing Sanai Takaichi's mandate. She reiterated plans to suspend the 8% food sales tax for 2 years, despite funding concerns. Nikkei 225 jumped almost 4% to a record close, while the yen briefly weakened before stabilizing on intervention warnings. Why it matters? A durable supermajority enables aggressive fiscal expansion and potential constitutional changes without coalition constraints, raising questions over long-run debt sustainability. Higher anticipated issuance has pushed the 10-year JGB yield to multi-year highs, pressuring the BOJ to choose between tolerating steeper curves or tightening policy sooner. The move reshapes global rates and FX via yen-funded carry trades and reallocations into Japanese equities. Key numbers to remember. LDP, greater than 316/465 seats, lower house supermajority secured. Food tax, 8% levy suspension proposed for 2 years. Nikkei, fresh record close with biggest one-day gain in months. What to watch next? Focus shifts to Takaichi's post-election fiscal package. Size, timing, and funding mix will anchor JGB supply expectations. Markets will parse the next BOJ communication for tolerance of 10-year yields near or above recent highs and any tweak to de facto yield caps. Sustained foreign inflows into Japanese equities could amplify global factor rotations away from defensive U.S. duration. 2. China tells banks to pare US Treasury exposure. Primary asset classes impacted. US Treasuries, 10-year, 30-year long end. DXY, USD/CNH, EM local bonds and FX. What happened? Chinese regulators advised banks to limit fresh US Treasury purchases and trim large existing positions, citing concentration and volatility risk. The informal guidance, communicated ahead of a recent Xi-Trump call, does not apply to state FX reserves managed by the PBOC. No explicit reduction targets or deadline were disclosed. Why it matters? China's banks are meaningful marginal buyers of treasuries. A sustained pullback lowers structural demand as foreign holdings sit near record highs. Even gradual rebalancing into domestic sovereigns or policy bank paper can lift term premia and steepen the U.S. curve amid heavier issuance. The move reinforces a broader de-dollarization narrative across EM, with potential spillovers into USD funding conditions and swap spreads. Key numbers to remember. Foreign UST holdings, around record multi-trillion levels. Scope, commercial banks only. PBOC reserves excluded. Motivation, concentration and market volatility risk, not explicit credit concerns. What to watch next? Monitor bid composition at upcoming 10-year and 30-year U.S. auctions, especially indirect demand as a proxy for official and bank participation. Persistent softness there would validate higher-term premia and a steeper curve. Watch USD/CNH and onshore CGB yields for evidence of portfolio rotation, alongside any U.S. policy response if Treasury demand weakens meaningfully. 3. Tech rebound, weak dollar and data cluster reprice global risk. Primary asset classes impacted: U.S. and global equities, Nasdaq 100, S&P 500 growth semis, DXY and G10 FX, UST 2 years to 10 years, gold and crypto. What happened? U.S. tech extended last week's sharp rebound, with Oracle and other AI-linked names rallying and keeping the Nasdaq 100 ahead of broader indices. At the same time, the dollar index slipped below 97 as markets braced for rescheduled U.S. jobs and CPI data later this week. Risk appetite improved across global equities and EMFX. Why it matters. The combination of renewed AI and cloud optimism with a softer dollar supports global risk assets via easier financial conditions and strong U.S. equity leadership. A weaker DXY reduces pressure on EM funding and commodities, while still elevated U.S. yields keep the front end sensitive to incoming data. How the clustered NFP and CPI prints land versus expectations will determine whether this Goldilocks repricing can persist. Key numbers to remember. Nasdaq 100 outperforms broader U.S. benchmarks on tech strength. DXY trades in the high 90s 60s/low 90s 70s after recent slide. Key U.S. data, January jobs and CPI, both due this week after delays. What to watch next? Focus is on whether NFP and CPI validate a soft landing narrative. Solid growth with gradually easing inflation. A benign combination would underpin global equities, EMFX and credit while capping front-end yields, whereas hotter prints could quickly re-steepen the curve and re-energize the dollar. Positioning around U.S. megacap tech and high beta FX will be the main transmission channel. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.